Well, look, I think when you think about yesterday, just putting aside what the cause was, and you think about what's likely to happen in the near term, even on the good days we've seen within this correction, I think we're still operating within that correctional phase. You know, you look back to Monday, the market was up over 1%. Advancers decliners on the NYSE, only 3 to 1. We still have less than 50% of stocks trading to new one-month highs. These are areas that we would look to tick the box on the technical side to say, okay, we're ready to see a momentum shift now to the upside. And I think this has probably been beaten to death at this point, but with that technical backdrop, I guess it's not that surprising to me to see yield curve inversion lead to a little bit of a one-day panic. Our particular point of view is it's not really a good timing tool. I think you go back throughout history, you have to acknowledge the fact that the yield curve inverted, but you're not going to be able to time the market based on that. And I went back and looked at 2s and 5s inversions just to get a sense for what that tends to do. So you saw an inversion November of 2005, October of 98, and then December of 88. In all three of those periods, it was 18 to 24 months before the market peaked. So I think everybody needs to take a breath, acknowledge the fact that it happened, but it can't be the only thing you use in your calculus.
Okay, so how do you get set up for 2019? I mean, is cash all of a sudden looking like a viable option here?
Look, no. I mean, it's a viable option more so than it was before, clearly. I mean, rates have gone up quite a bit. Now, I'll break my own rule here a little bit, but using interest rates to kind of justify where valuations are. When you look out over the long term, it's not such a good idea. Typically, starting in the lowest interest rate regimes, actually returns over the next 10 years are not very good. But in the near term, I think low interest rates could still perpetuate valuations where they are right now. I think a way to quantify where rates are versus where fundamentals are, you look at the equity risk premium, right? So flip PE on its head, subtract out the 10-year Treasury yield, you're still at about 260 basis points. 12-month forward returns look generally good when we're at these levels. We're still one standard deviation above average on the equity risk premium. So in that regard, I think we could still have some room to run in the short term.
You know, somebody at home might be thinking, though, we were just at 3.25% not too long ago.
Yeah.
And that's when the problems really started happening. I mean, it feels almost like we're boxed in. I mean, yeah, lower interest rates can justify valuation, but for how long? And if that pain point was 3.25%, which was basically the highest we've gotten in the recent interest rate run, I mean, that's not much of a runway.
Yeah, and I take what Tim said just a couple of minutes ago as it relates to you don't necessarily want the Fed to have to back off because they simply can't raise rates. And honestly, that's been the case. If you look at the correlation between stocks and interest rates, it's only turned negative 3 times over the past 20 years. It was 99, it was 06, and it was 14. Not necessarily the greatest environments for markets. And although we didn't go into negative territory, we approached negative territory. So you're getting to a point where interest rates started to look like they were rising to a level that was restrictive to business activity, and then the market was reacting to that. So part of our thesis, although it might not be great long term, is that the Fed needs to back off a little bit if we want to see the market rise next year.